Well, Sanjay Bukham of JP Morgan actually has come out with a very interesting note to his clients. What they are saying is that at this point of time, it appears as though the Indian markets that had a one-sided rally in 2020 and in the beginning month of 2021. At this point of time, it's time to stop, take a breather, take a pause, and actually relook at what exactly are the key drivers going forward. Now, also what they are saying at this point of time is that it appears as though largely it doesn't appear as though India would not really be going ahead and outperforming other emerging markets and global indices. They believe India will continue to move in tandem with other global markets and other emerging markets, mainly due to the fact that there is no large domestic event that is enough or big enough to actually decouple Indian markets from other global equity markets. The other important phenomenon that they say is the fact that the global bond yield spike is definitely adding to the pressure as far as Indian markets are concerned. Valuation is a big concern given the fact that historically, when you're comparing the current valuation to historic figures, right now the market is quite overvalued both in terms of PE to its own self and also when you're comparing the valuation trends or valuation bands to other emerging markets and global markets. They also note that given the fact that the rising number of corona cases is a bit of a worry, they also believe that a lot of market participants are on a wait and watch mode. Now going forward, what they're saying is that the IT pharma commodity trade is something that could work right now given increased emerging market concerns. They are saying that for rates to further fall down, you need to see the impact of negative real interest rates. Also, they believe that the risk allocation for 2020 actually indicates that Indian equity markets could actually go ahead and move further higher. Lower interest rate could drive top line for rate sensitive like banks and NBFCs. They remain overweight on financials in the hope of a growth rebound. They are believing HDFC Bank and ICICI Bank in financials. Now going forward, another important thing that they're actually going to say is that the recent decline in oil prices, remember oil has been on the boil, they believe the recent decline in oil prices could actually help economies like India. They believe that lower interest rates, like mentioned before, could actually drive the top line for rate sensitives. They believe lending in general could see an uptick. Real estate as well as associated sectors could do much better in terms of top line. Lending in automobiles is also something that they actually see going better. Select discretionary stocks is something that actually see a bit of a rebound every time you're actually seeing a decrease as far as interest rate is concerned, and the lending environment actually becomes quite favorable. Going forward, the rapid rise of coronavirus or the second wave is something that is causing a bit of a concern, and this, they believe, could actually have a serious impact on equity markets going forward.